Your Forex broker will rob you. When the best trading opportunity arises, your broker will try to make you lose. In this video, I will reveal a common scheme bad brokers use to stop you out from the trade, and real examples of how they do it. So here's the story. This week I found a profitable trading setup. It had a strong, both fundamental and technical rationale. On a cat Swiss pair, the price tested a significant liquidity demand zone that was based on a recently broken trend line and a significant horizontal support. Our plan to buy was based on a breakout of a consolidation that happened after a test of this liquidity zone. I shared the setup for free on TradingView, and I explained the trade execution rules for this setup on a live stream with my Academy members. When the price finally retested a broken resistance of a consolidation, we finally started entering the trade. I opened this trade in the evening and I decided to keep this trade overnight. And only the next day during the London session the market reached the target. Then I started reading messages from my subscribers and I realized that many of them closed this trade in a loss. I started to look for reasons why it could happen, and I came to the conclusion that many traders were trapped by broker manipulations. Here's why. I started studying the setup on charts of different brokers. On TradingView you have an option to open the same Forex pair with different quote providers and brokers. Here is a price chart of the same Forex pair with the broker of my student. You can see that the price went substantially lower and he was kicked out from the trade. But when I continued checking how cat Swiss pair was moving on charts of different brokers, I found this. With another broker, this bearish movement was extreme. The price set a low 12 pips lower than a low of my broker. Obviously, that price movement was a manipulation. Some brokers were simply trying to stop hunt their traders, making them close their buying positions in a loss. Good news is that such manipulations can be avoided. To understand how to outsmart your broker, let's see when exactly these manipulations happened. This manipulation occurred when the market transitioned to a new trading day. Such an event is also called the session rollover. It is 5 p.m. New York time, which often corresponds to midnight or 1 a.m. of many trading platforms. At this specific time, institutional desks close. Major banks and institutional liquidity providers in New York are closing for the day, and the next session is not yet opened. The next major financial center like Tokyo hasn't fully opened its desks yet. This creates a low liquidity environment. With fewer participants and thinner order books, it takes significantly less trading volume to move the market price. This is the perfect ground for manipulations. At the same time, when liquidity drops, the spread can increase dramatically, sometimes from 1 to 100 pips or more. For example, look how frequent are manipulations during the session rollover with this broker. Also remember that some bad brokers will abuse the lack of liquidity during session rollovers. That is why it is so important to trade with a trusted broker. Look at two charts of a Euro-Swiss pair of different brokers. You can see that on the left chart, broker abuses the session rollover and uses the traps, while with the broker on the right, none of these manipulations occurred. Crazy difference. The best strategy to avoid manipulations at that time is to consider avoiding trading at rollover. If you have an active trading position, simply close that before a rollover and reopen that after. Broker manipulations during liquidity rollover are very frequent. Being aware of such a significant moment will help you to not be caught by artificial price movements. Let me know, traders, in the comment section if you want to see more videos about manipulations in Forex trading. Thank you so much for watching, and please do not forget to watch my other videos.